thought I'd just put down or just speak about the differences in business structures that you can use to trade it. Traditionally, people start out as a sole trader, which is basically trading in your own name. Basically, you are the business. Whatever you make, whatever income you make becomes your income, as opposed to when you get to structures like trusts and companies where they actually are a separate legal entity. If you're trading in a trust, for example, the trust would make sales, it would trade, it would hopefully make some money anyway. We'd like to think it would make some money. And at the end of the year, that income that has been made has to be needs to be distributed to the beneficiaries of the trust, and those are determined by the trust deed. As to who is eligible, we tend to favour beneficiaries or bloodline beneficiaries, so they're family members essentially with the same bloodline as the trustee. What would then happen is the trustee, because these trusts are discretionary trusts, would at their discretion decide to appoint the income as to the various beneficiaries, and there could be more than one, often a husband and wife. Sometimes there's an adult child in the company. That income gets distributed by way of resolution and has to be done by the 30th of June. And then whatever income is appointed to the various beneficiaries, they will pay tax on that in their tax return. So that would become their income and their responsibility to pay the tax on it. The trust itself won't pay tax unless the trustee fails to make a distribution, in which case the trust is taxed, my apologies, and that's at 47%. So unless the beneficiaries' marginal rates are at the maximum rate of 47%, there's a serious disadvantage to not distributing that money. Another popular structure people use is a company, and a company's a legal entity. It has a Pty Limited on the end generally. It has an Australian company number, so that's a distinct number, and it is a legal entity in its own right. It has been called a judicial person. So the company will then trade. Often the directors might take a salary or wage out of that. And at the end of the year, there might be we like to think there's going to be some profit left at the end of the year, and that gets taxed at the company tax rate, and which is for the smaller companies is about 25%. So a lot of people making a lot of money would prefer to keep the money in the trust so that they don't have to pay the higher tax rate in their own right. So there's really three ways you can get money out of the company. You can take a wage, as we've discussed. The other thing is, once the year-end happens and the company lodges a tax return, it then has retained income on its balance sheet, and that can be given to the shareholders by way of a dividend. And those dividends come with the franking credit, because Australia doesn't have a double taxation situation. You're not going to pay tax in the company and then pay tax on the dividend. So what will happen is you'll get a credit for the tax that's already been paid by the company, and then that income would go over to you as a dividend with a tax credit attaching to it. The third way money could come out of a company is by way of the directors taking a loan. So if, for example, you need money for another venture, taking it up by way of dividend or wage, there's going to be some tax consequences immediately. So if you take it out as a loan, that tax consequent gets deferred basically to the next year and longer in a form known as a Division 7A loan. Now that might be a good way to, you could take it out as a loan now and repay it by way of declaring a dividend later. There are various permutations that you can have. That is essentially, that loan has to be paid back within 7 years. And the reason why you might do that is that at least if you need money for a specific project, you'd take the full amount as opposed to the net after tax amount out. But bear in mind, you do still have to account for that Div 7A problem. There are various other structures that people use. Quite often people use a company as a trustee of a trust, and the trading happens in the trust, but the trustee company has a benefit of providing a layer of asset protection by way of limited liability, because the trustee effectively runs the trust, and the trustee's a company in this case, and a company has limited liability, and that your liability is limited to your investment and at the share capital that you've put in. Unless, of course, you do something silly in your trading and, like trade insolvent or do something that you shouldn't be doing. Other than that, you do have a form of asset protection applying to that. There's various forms of trusts as well. You can get discretionary trusts. You can also get unit trusts, which are fixed owner. You'd have a percentage ownership based on how many units of the total you own. That's another quite commonly used structure. And there are a few others, but the purpose of this is just to be very basic and just point out that there are some different structures around. Happy to talk further in person. There's no one size fits all ultimately. If you were to ask me the question and you were a trading guy and you said, what's the best structure for me? Well, the answer that I give you and the answer I might give your next door neighbor or your brother or something probably might not be the same, because a lot depends on your personal circumstances. What works for one person might not work for someone else, or might work better or something. So it's a very individualized process that you go through to decide what the best way to trade is. Partnership is one that I haven't mentioned. People do trade in partnerships. Personally, I see it as the worst possible structure that you could go into, in that the partners are jointly and severally liable for the liabilities of the company, of the partnership. In other words, if partner A goes bankrupt, they'll look for partner B for the money. So partner B effectively is guaranteeing partner A's debts. You don't really want that. There are better ways. And it's one of the things I like talking about. So I'm quite happy to discuss that with anyone who wishes to. So yeah.